Hello, welcome to the channel. So today, what a crap show. All right. Well, gee, the inflation numbers came out and Mr. Stock Market did not like it. Look at this today. Let me zoom in here. You're looking at like on the SPY down 2.9%, and you're looking at really, look at that gap down and continue to go. And then you also had some decent, like heavy volume with that guy. Let's look at what happened with the Qs today. And the Qs, same kind of thing, gap down, crap, gap down, crap. Dow Jones Industrials, anything? Look pretty horrific too. Now, let's look at the weekly on these guys. Because we look on the weekly, like we're really like we're pressing down to the previous lows. So it's very concerning because yeah, I mean, you're pressing down, getting very close to the previous lows, and so of course the question is going to be: are we going to break through those new lows? Given that apparently it looks like Wednesday we have the Fed meeting. Given the inflation today, there's a lot of talk of a variety of different things. So let's look at the inflation first. I want to look at this macro micro. I'll put a link in there, and they just have this chart on all kinds of charts, but one of the charts is this U.S. Cleveland Fed inflation, this nowcast CPI thing. Now, what was really interesting today is if we look at this, the blue line is the actual CPI. So I know it's very hard to see, but right over here, the blue line is the actual CPI. And then the Cleveland nowcast, so year over year, these are the year over year numbers. You can see that the nowcast had, as I had in a previous video, I kind of said, hey, look at this nowcast is forecasting that we're pivoting back up, meaning that we're not in a downtrend on the inflation. It looked like it. We had the previous, right? So the previous month, we did have a little downtick in inflation. But that has kind of changed, at least with the year over year data. And that was kind of forecast with this nowcast. But what's also interesting, if you look at it, is the blue bar, which is the actual CPI year over year, was actually more than expected. Now, this is something that we see in the past. You see that the nowcast is a little bit understating it some of the time, so that kind of goes with that as well. And then on the core, year over year is in the red, was higher as well, so that would be the red straight line versus the Cleveland green line. So now what I can do, let me just look at a different chart so we can go over here. And what we're looking at here is, let's look at this core consumer prices. So this is the consumer prices. Okay, we see that. And this is on this trading economics website because they have a decent chart. But if we look at our inflation rate, okay, so this is going to be your headline inflation. And we can see that, hey, look, we're turning up again. We were at 8.5. We had dropped to 8.3. The expectation really was something like this, was something to come down and drop to a little bit lower, just working your way down. Instead, we get this huge 8.6, which is actually higher than not only the previous month, but the month before that. So the issue is, if you were looking at it and saying, we're really hoping that this thing was doing the curve over, that's not what we're seeing. Right. So at least for now, we're not seeing that. Now we have a little dip like this, and then it's come back up. Now the question is, what do we expect? Like, I mean, this is getting to be high inflation. So I mean, I find it really hard to believe. I think it could tick up more because there's a lot going on. But I mean, I really find it hard to believe it will tick up too much, just because, 8-9%, inflation is really hard to sustain at some point. But it looks very likely that maybe what we'll do is we'll kind of be in a range for a while, and then hopefully we'll start tailing off. So either way, this is actually kind of horrific. Now let's look at the core inflation rate, see what happened there. Now, see, this is pretty good here. Looking at the core inflation rate, we did have this rollover, and we did kind of see it stick. So you can see that you have, came down 6.5, 6.26. So on the core, I mean, it looks pretty good. But on the overall inflation rate, apparently the market was unhappy. And it's kind of interesting. You kind of can't really always tell. You can't really tell what's going to happen with that. So another thing to look at. So why do we have all this high inflation? I mean, obviously the core removes your energy, right? So your oil price and your food price from the calculation, right? However, your food and your oil goes into the cost of everything. So it does push up core eventually, but it isn't as volatile as the actual measuring, the price of gas going up, et cetera. So in a way, it was like positive that the core did kind of tick down, but you would have hoped that the other part of it, the headline inflation rate, would have not been this bad. That would really uh, you would hope that that would not be the case. Let me look at this. Yeah, so the overall inflation rate here, yeah, ticking back up to 8.6. So yeah, so the market really didn't like that. We get this huge sell-off in the market. We're pushing towards back towards the lows. Um Not good. Now, one of the things to understand about this inflation rate, we do have supply problems. We do have, the conflict in Ukraine. We have this, efforts by countries to try to, ban energy, oil and natural gas imports. And to what extent that's going to happen, I don't know. But if we look at that, oil is continuing to go up. If we look at our Brent crude on a weekly, I mean, it's just continuing to press up, kind of that symmetrical triangle thing. It just kind of continued to press up. And then also on our 10-year, the yields popped up. Now, this is kind of interesting because it's really looking, if I look at the 10-year treasury yield, it's back up near the highs, the recent highs. So it's really looking to try, as far as I can tell, it's really looking to try to make a breakout here. So now I want to go and just let's look at even a longer term chart of this 10-year. And that's probably too long. But one of the things you can see is that we've had historically, I mean, in many people's lifetimes, I mean, rates have been declining, So for me, I mean, they've been declining since what, the 70s or whatever. And so since I've a kid, my whole life, rates have been declining. And so, the question is that going to change now? And the answer is, well, maybe. If we look at it, you can see that's what's really interesting here is that this 3%, this high over here is this is a high that we haven't had for a long time. I mean, we were back up there, out above that, I mean, a little bit here in 2013, and then we were above that going back 2010, 2011 area. So it's been many years since we've been above 3% on the 10-year, and we're really making a run at it. So my expectation would be at this point that it's probably going to break out at some point. Can't tell you exactly when, but given that you have some resistance, and it comes off it, and then it's going to run at it again, and maybe it falls, and then maybe it does this or whatever or something. In very often, I mean, usually it makes it through, depending what it is. Now, so where's the inflation coming from? So we have the issue of the supply chains, we have the war in Ukraine, all that stuff going on. But another thing that I want to look at is M2 money supply, because we know back here, so we're going to go back and we can see that, look, the M2 money supply is just going up and up and up, and it's been at a rate where it's going up. Now, the way it works is you can get away with the money supply increasing a lot if it's not increasing more rapidly than the general economy, more rapidly than the population growth, et cetera. Then you can grow it. I mean, there's an argument for growing the money supply proportionately with the size of the population, et cetera, that kind of thing. But we can see what happens in the cerveza sickness over here. All of a sudden, back over here, we just shot up. We created incredible amounts of money. But there's something else. It's really interesting. So, the rate of money increase was something like this. And then the rate of it is, okay, it's steepened up. In the 2009 financial crisis, you can see the money supply increase rate, picked up. You see how the slope has increased. But this thing went hyperbolic, right? It went hyperbolic for a small period of time after the cerveza. But look at this continued rate. The continued rate of money growth is still much higher. So you're looking at, an angle here that, it's just a very large growth. So, your fee, fee one, your angle there is some number, and then your angle here, is much greater than that angle. So it's just less sustainable. And so my point is that expecting the inflation to come off with the money supply still growing at this rate is very unlikely. I mean, yes, we might get disinflation where we can get lower, still have high inflation, but like it's at 8%. Like maybe we can get inflation down to 5%, which would be better than 8%, but it's still not like low inflation. It's still not deflation. It's not negative number. But it's lower rate of growth. But the point is, part of the reason that I think that this is happening is because, look, we still are growing, as I said, at a much faster rate. And it's only recently in March we peak, and then April we finally start to decline. You can see that there. I'll zoom in some more. You can finally start to see that the money growth is finally crossing the curve right now. And it's very subtle. You had a little bit of a slowdown in the growth here. And otherwise, you've been on this, fairly significant growth curve. So what that means is my thought would be this. My thought would be that, look, this whole boost in the money supply here contributed greatly to the inflation we have, plus everything else. But all this increase in money supply, even though it's not as fast, in other words, it's not at this rate, it's not going like that, but it's going like this. I mean, it's still kind of pushing up inflation. So now we finally have the money supply dropping off. And so my guess would be is that, look, it's still going to take more time. This is going to have to drop off some more, or more likely, it's just going to have to level off for more time before the inflation is going to get behind us. Because, you're just putting this money out there. It's really interesting, like, where's the money coming from? Where's the money going to? I mean, we know we've had less of the stimulus type stuff, but yet money is still getting out there, and it's getting out there to people. Now, it could be, we've seen this phenomena where people are running up their credit cards right now, and that could be part of the issue, right? So in other words, people may be getting the money on credit, which is increasing the money supply, et cetera. And maybe that's where they're getting it. So instead of stimmies, they're like charging it on their credit cards, which is, anytime a bank gives you money, they don't have the money. You can see George Gammon for that. And, they're just making the digits out of nowhere. That's how it works. So my guess would be, yeah, more inflation, which now raises the question, what is the Fed going to do? Is the Fed, I believe they have a meeting coming up this week. Are they going to raise by 50 basis points, or are they going to be forced to maybe do some more? I don't know. Some people feel that, like, hey, look, they've lost control of it. And therefore, given the situation, maybe they should go ahead and just raise it by a full 100 basis points, which would be a full 1%. Other people are out there thinking that, hey, they should go ahead and do it like this weekend. Just go out there and say, look, we're raising rates by 1%. I doubt they'll do that. I mean, because that will just cause such a break in the market for them to do that. I don't think they want that to happen. I think that they have a view that, remember, they can be very steady and apply consistent pressure. In many ways, when you look at some of the things in housing and mortgage applications decline and all these different things going on, an increase in interest rates that have occurred, when you look at all that stuff and you kind of put all that stuff together, they are having that effect. And so therefore, if you look at it from the view of the Fed, I mean, they're having that kind of effect. I mean, they are slowing the economy. So what are they doing? What is the Fed doing? Well, the Fed's going to get rid of inflation. How? I mean, the Fed can't print or make stuff, et cetera, et cetera. So how did they do that? They kill the demand for it. And the way that you kill the demand for it is how? How do you do that? Well, you push rates up. So they're pushing the short end, and not even much, but they're also doing several things. First of all, they're backing off. They're starting to actually they stop buying, number one, their treasuries and mortgage-backed securities. Secondly, now they're into the phase where they're actually supposedly starting to sell their treasuries and the mortgage-backed securities. So they're not out there buying. So very simple, if they're out there buying treasuries, they're another buyer, right? So they're out there buying it. The higher the price of the treasuries, the lower the rates. So the Fed can help on the margin, push those rates down. With them doing the exact opposite on the margin, they're going to push those rates up. And then in addition, if you're in the market and you're trading the bonds and you're there and you're dealing in that market, you're going to run ahead of the Fed. If you know the Fed's going to stop buying, if you know the Fed's going to start selling, you have to prepare for that. And that may and very well mean that, hey, you're going to have to sell some of your treasury, sell some mortgage-backed securities. If you're writing mortgages, you may very well have to make sure you're getting a better rate because, you don't want to be stuck. And just looking at the average 30-year fixed rate here, we see that it's it had peaked up as high, and this is on a weekly, so it peaked up as high as 5.3, and once again, it's doing one of these things, came down and starting to go back up again. So the higher those interest rates for mortgages, just the more pain that is for the housing and the car market. So I think we're in that situation where you're just gonna see it. You're seeing it flip so fast. You're like, there's like in housing, there's not enough inventory, not enough inventory, not enough inventory, not enough inventory. And all of a sudden, like people are they're gonna be like, it's like you're on this beautiful cruise ship, and it's like you're in the upper decks and maybe some of the lower decks, but you're not down in the lowest decks of the engine room and in the lower decks of the ship. And you think, wow, this is a beautiful, well kept ship. And but then the ship starts sinking, and all of a sudden, here you are on the promenade deck, and all the rats are coming up. And it's like, that's kind of what's happening with housing. It's like, okay, no one wants to sell. No one wants to sell. Well, of course, no one wants to sell because it's still going up. But as soon as there's like a tick down or like rates going up, I mean, and it's like, oh my gosh, people, all of a sudden, all these people are going to come out of the woodwork like rats coming out of a sinking ship. They're all just going to pour out and just flood the market with inventory. And we have a new dynamic. And this is a really good one to kind of keep in mind. The new dynamic that we have is after the financial crisis, at some point, the BlackRocks of the world, these big companies started buying many single family homes, and they bought tens of thousands of them. Now, in the margin, even though overall it's a small percent of their overall homes, but on the margin, when they're out there trying to buy homes in a particular area, whatever it is, they're like, oh, we do the math and blah, blah, blah. Florida is a place where we can buy homes and make a decent return renting. So we're going to be buying in there. And so, if they did that kind of thing, et cetera, et cetera, et cetera. But now they're going to do the same math. What math are they going to do now? They're going to be like, okay, well, I made this much on the housing, and the house is still up based this much. But, if those guys that come out there and they want to start doing a sell program, it would be not unlike you would see in the stock market where you have sell programs come out and they are trying to move so much stock. Now, they would be, I think, as smart as they could be about it. Right. So they would, try to avoid the big days like this. But on the other hand, they would be pushing out inventory and they would let the prices drop to some extent. Right. And so that's new. So that, I believe, is new. So when you compare to the housing crisis, the financial crisis, housing crisis that we had, watch the movie Big Short, when all that was going on there in Florida, I mean, that all that stuff happened. And I remember I was in actually San Diego, and it was interesting. Like there was like new home communities where, just like foreclosure. And it didn't last that long. I mean, it came a couple of years, and then like these homes started buying up. It started recovering. However, the difference is at that time, there was not a lot of these big investors. It was still in the purvey of the little guy, the little guy who is like flipping homes, buying homes, had read whatever books, the Kiyosaki books and the real estate guy books, and, and they're trying to, just buy single family homes, work up to a point where they can get, an 8-door unit or something like that. So the small guys, now we have some big guys in there. So it will be interesting to see what happens with that. So in the end, interesting week. Uh, I wonder if the Fed statement coming up next week is going to be a no-brainer, maybe not much of a reaction because, the market is looking ahead. Maybe what the market said today is like, well, we're scared of what the Fed's going to do, or we're not happy that the Fed is definitely looks like they might go to 75, basis points, or, if some part of the market was thinking like, hey, look, the inflation's rolling over. So now maybe they'll only go to 25 basis points. Well, no, well, that could have happened today. That's all I'm saying. So maybe there won't be a big, huge volatility on the Fed day because the market may have made its decision today and left it at that. All right. Well, that's it for this one. Uh, what is that old saying back in the Cold War, which we're sort of going back into now? Duck and cover.